Hey traders, my name's Austin Silver. I really appreciate you checking out this content. Before I let you into the video, I want to let you know that our newest course is available totally for free. This course was so successful for us since 2019 that I've decided to amplify it, turn it up a notch, and give you guys something for free. So if you like what you see here today, click the link in the description, go to asfx.tv. That's where our newest free course is hosted. We have a ton of content for you there as well. So if you enjoy what you find, make sure you subscribe and then head to ASFX TV for more. Thank you for checking this out and let me know what you think in the comments.
So now we're going to get into some of the terms that you need to understand if you're going to become profitable as a Forex trader. We're going to cover everything from pips to margin calls to stop loss and take profit to bid and ask, leverage, the whole 9 yards. So let's jump right in with first explaining what the difference between going long and going short is. Long is the act of buying. It's when you believe a currency pair's price is going to rise. So here in this example on a chart, you can see price goes higher across your screen from left to right. And if you were to enter long here, as you can see, I priced it out 1.13109, you would then have made money that day because price went higher from left to right. By the end of the day, price was way higher than where you had originally went long down here. So inverted to that, you have what going short means. Short is the act of selling. It's when you believe a currency price will fall. Here you can see as the day goes on, it moves lower from the short entry price of 1.91931. So again, long is when it is going to go higher. Short is when it's going to come lower. When we talk about currency pairs, there's two currency pairs in the exchange rate that we're trading on. The first pair is your base pair. So in this example, the euro is our base pair. In the second example here, we have the quote pair, the second pair in your currency quote. Put them both together and you have your base and quote pair. This base pair is the currency you're buying when you trade a Forex pair. The quote currency is the currency that you're selling, because when you are trading in the Forex market, you're simultaneously buying one currency and selling another currency. So if you're long GBP USD, you're buying the pound and selling the dollar. If you're short pound dollar, you're selling GBP and buying the dollar. Make sense? Good. So let's keep moving. Pips. This is basically the way that we measure movement in the Forex market. When we talk about trading stocks, you always talk about it in terms of dollars and cents. In the Forex market, you use the word pips to measure price in percentage or point in percentage instead. So the easy example that I can give you is if we have Euro USD quoted at 1.12345 with those 5 decimal points, right? We can look at that and see if the 34 changes to 35, that's an increase of 1 pip. If the 34 changes to a 44, that increases us by 10 pips. So you can see the second digit from the right when you're reading a currency pair is your ones digit holder when counting pips. The third digit from the right is your tens placeholder when counting pips. So here, if it goes from 1.12345 down to 1.12305, that's a decrease minus 4 pips. So the digit on the end, you're probably wondering what that is your pipette. That's a fraction of the overall pip. So I don't count pipettes because truthfully, even if you're trading big size, they don't mean as much as a full pip. They're not worth as much. So what I try to teach everybody to focus on is that second to last digit there. That is the most important digit that we want to be focused on. So you want to start counting pips, like I said, with the second digit from the right, no matter how many decimal places there are. For some of the JPY currency pairs, some of the exotic currency pairs, they won't be quoted in 5 decimal places. They might only be quoted in 3 or 2. Gold is quoted differently, right? You always want to count pips from the second digit place from the right. That's your number one starting point when counting pips. So now that you understand pips, let's talk about the bid, ask, and the spread. You've heard me mention this before when we talk about a currency being quoted in 2 different prices. So first, the bid is the price that you can sell the base currency. The ask is the price that you can buy the base currency. So if we look at this example here, in Euro USD, if the bid is 1.24354 and the ask is 1.24362, that would mean that the spread is 0.8 pips. The difference between the 35.4 and the 36.2 is 0.8 pips, and you can sell €1 for 35.4 and you can buy €1 for 36.2. So I hope that you understand now that you count the pips with that second to the right digit place, and when you're talking about the bid and ask, price is going to be quoted in two different ways: the price that you can buy the base currency and the price that you can sell the base currency. And the difference between those is the spread. The size of the spread reflects three things, and it's important to understand all three. First, liquidity. The more available that a currency is for us to buy and sell it, the smaller the spread is going to be. You also understand that size is very important, because the bigger the deal, the wider the spread, because the broker is taking on more risk. And the time of day that you're trading also impacts the spread, because spreads open up when markets that you're looking to trade are closed. For example, if you're trading Euro USD during the Asian session, it's going to be a larger spread, especially if you trade during the changeover of day, like I spoke about earlier, and we're going to go into that a little bit more. But there's a gap time when brokers change from the from the New York market into the Asian market to the Australian market. And in that hour, it's about 5 to 6 p.m. New York time every day, spreads always tend to open up for most brokers. So now that you understand pips, pips, spread, bid, and ask, we're going to move into lot size. Lot size is basically your position size, because currencies are traded in lots, batches of currency used to standardize Forex trades. In Forex trading, a standard lot 1.0 is 100,000 units of currency. Alternatively, you can trade smaller in mini or micro lots worth 10,000 or 1,000 units of currency, respectively. Now, dollar for pip, these lot sizes will change how much your trades are worth, because you can see micro lots are only worth 10 cents per pip. Mini lots, on the other hand, are worth $1 per pip, and standard lots are about $10 per pip. Now, this is going to change depending on what currency pair you're trading, but keep this in mind if you were to think about a trade example in your head. Let's say a trade moves 10 pips. If you were trading micro lots, you'd only make about $1. But if you were trading standard lots, you could make $100. So that same piece of movement on the same chart could pay one person $10 and one person $100. And that's very important to understand, because that is the essence of why I think Forex is such an amazing market and why I love being a technical trader, because the same patterns that pay the new trader on the block just $10 or maybe just $1 in his small trade, that same exact pattern on that same pair at the same time is paying somebody else $100,000 or $20,000 or $40,000 or $50,000. The same movement, only because they can put more size into it. So again, going back to the powerful attributes of Forex, having the ability to trade whatever size you want, whatever your broker will allow you to have, is such a huge, huge benefit to trading Forex. So I have a few formulas that I want you to keep above your trading desk. Keep them somewhere that you can see them. They're going to save you a lot of time, a lot of headache here. When we talk about counting pips, this color chart is going to really help you out. Remember, the second digit from the right is your ones digit place. That's where you're going to start counting your pips. The digit to the right of that, the digit all the way on the end, no matter how many decimal places there are, the digit all the way on the end is going to be your pipette. That's a fraction of that pip. That's why we start counting here. Going to the left, you then have the tens digit holder, the hundreds, the thousands, and the tens of thousands digit holder. So you can count very easily. Okay, if the 2 changes to a 3, that's an increase of 100 pips. If the 2 decreases to a 1, that's a decrease of 100 pips. Make sense? Another formula to remember is if you subtract the bid minus the ask, you're going to get your spread. And if you multiply the movement in pips times your lot size, you're going to get your profit and loss. So these are the important formulas for now that you need to understand. So screenshot this, put it right above your trading desk. Now, let's move into a quick quiz. If you're trading Euro USD long from 1.12345 to 1.12565, how many pips did this trade travel? 3, 2, 1. The answer is 22. How do you do that very quickly? 56 minus 34 is going to give you 22. But because we said we were moving long, we were moving higher, the increase of 34 to 56 keeps this a positive number. So when you multiply where it went to where it was, you can easily get how many pips it traveled. 56 right here minus 34, because the 5 on the end didn't even change. And even if it did, personally, I wouldn't even add that into the equation. It's just a fraction. So I'm really just worried about the digits on the digits starting from that second digit to the right. Another question for you here. You're trading Euro USD long from 1.12345 to 1.12565 again. How much would that 22 pips of movement be worth if you were trading one standard lot? Ready? it would be $220. Why? 22 pips times $10 per pip on a standard lot gets you $220. Another question for you here. You're trading the same trade, the same 22 pips, but now, instead of a standard lot, you're trading 0.4 a lot. How much would that trade be worth? $88. Why? 22 pips times $4 per pip, 0.4 lot, is $88. All right? Good. Let's keep moving. So we're going to talk about leverage. This is a very controversial topic. People love it. People hate it. Personally, I think that leverage is a powerful attribute of the Forex market, but you don't want to rely on it and you don't want to be greedy with it. You don't want to be overly aggressive with it. Using a small amount of money or no money at all to control a large amount of money is what using leverage is for. Like this picture here, the smaller rock is outweighing even the stack of these big rocks. You're using less to mean more. And it's expressed as a ratio, for example, of 1 to 100. And what this means is that for every dollar that you put into your account, the broker is going to give you $100 of purchasing power. Leverage allows you to increase your exposure to a financial market without having to commit much capital at all. When trading with leverage, you don't need to pay the full value for your trade up front. Instead, you put down a small deposit known as margin. When you close a leveraged position, your profit or loss is based on the full size of the trade. This means for you that leverage can magnify your profits, but it also can bring on more risk and amplify your losses, including losses that can exceed your initial deposit, and that's why it scares people. Leverage trading, therefore, makes it extremely important to learn how to manage your risk properly. Going very closely with leverage is margin. Margin is the term used to describe the initial deposit you put up when opening and maintaining a leverage position. When you're trading Forex with margin, remember that your margin requirement will change depending on your broker and how large your trade position is. The amount of money that you're putting with the broker is the good faith deposit to open that position. So, take, for example, a trade on Euro USD. It might only require 2% of the total value of the position for it to be open. This would mean that while you're still risking $10,000, you only need to deposit $200 to get the full exposure. So right off the jump, you can hear the difference, 200 to 10,000, and that would be almost over leveraging to some people and put you at more risk to blow that entire initial deposit. When you carry out a Forex transaction, you don't actually buy all the currency and deposit it into your trading account. Practically speaking, what you do is speculate, like I said before, on the exchange rate. In other words, you estimate how the exchange rate will move, and you make a contract-based agreement with your broker that he will pay you or you will pay him depending on whether your estimation has proved to be correct or wrong. Example, whether the exchange rate moved in your favor or against your initial speculation. And understanding these margin requirements is going to help you understand how to max out your leverage. So we spoke already about the difference between Forex and stocks on the jump, on the initial things of where their differences lie. But understanding margin and their differences between there is very important because a lot of people associate trading on margin as being a bad thing. But the margin that we use in the Forex market is completely different than the margin that most people are speaking about when they say that trading on margin is bad. Because buying on margin is a term that basically means taking a loan out from your stockbroker to purchase stocks. But margin in Forex is the amount of money that you have to deposit to keep the broker happy when you open a position. It's not a loan, and you never own the underlying currency pair. You're not taking the money as a borrow as you are in the stock market. So understand that the difference between margin with Forex and margin with stocks is that when you talk about trading securities on margin, you're taking a loan out from the stockbroker. But when you talk about margin in Forex, we're talking about the initial deposit that you need to open the position using that leverage. Now, the reason that they give us such high leverage in some situations in Forex, compared to stocks especially, is because the Forex market doesn't move 5, 10, 15, 30, 40, 50% a day. It moves, honestly, some days less than 1 full percent. Less than 0.5% sometimes. So in order to make money on those small overall moves, you need to leverage up the size of those positions. And that's why leverage is available in Forex completely differently than it is in stocks, right? And margin is used completely differently in Forex as it is in stocks. So understand that you are not taking a loan to take these trades, as you would if you were trading margin in the equity market. So let's talk about stop losses. These are very important. This is a price at which you would be out of your position because it's moving against you. You set the stop loss, or you can set the stop loss as soon as you take the position. As soon as you enter a trade, in my opinion, you would always want to be setting a stop loss. I've never been a trader to trade without a stop, and I've never met a profitable trader that trades without a stop. So the stop loss is going to be there if there is an erratic spike, if the trade just actually happens to be a loser, or if you happen to make a mistake. This is going to cut that loss and make sure that you can survive to come back for the next fight. Right? So when you're long, your stop loss is going to be below your entry price, because if it drops, you're losing money because you're long, anticipating that it'll go higher. And if it moves lower to a certain point where that stop loss is, you would want to be out of the trade. Inverse to that, when you're short, your stop loss is above your entry price, because if the price continues to move higher and go against you, you're going to continue to lose money, and at some point, you want to cut that loss. So here, back to this short example again, the stop loss is above the entry price, as you can see here, 28.1 pips above the entry price, and this ends up moving lower into profit. Where does that go? Down to your take profit level. The take profit level is the price where your position will be closed in profit. It's very important to use these as well. A lot of traders will not use take profit levels and will just try to feel their way out of every trade. Anytime you try to feel anything in trading, you're going to lose. So understand, when you're long, you want to set take profit levels above your entry price, meaning if price continues to rise, you're in the blue, you're making money, you want to be out of the trade here because it fits the rules that you're using to trade. And as we move through this course, I'm going to show you very specifically where you're going to put your stop loss, where you're going to put your take profit, and how you're going to know how to do it every single time based on the patterns that repeat. So when you're short, naturally, your take profit level is going to be below your entry price, because if you're long, you want price to rise. If you're short, you want price to fall. Here's another example here. Your take profit down 75 pips, as you can see, 76 pips below the entry price up here. So again, stop loss above, take profit below when you're short. If you're long, it's going to be inverted to this with the take profit above you and the stop loss below you. Get me out of the trade. Stop the loss. That's how you can remember that. Now, let's talk a little bit about risk-reward ratio. Another word for this is your R multiple. Sometimes you'll hear me talk about, let's take it to 1R, let's take it to 3R. The potential here is 2R. This is a very important piece of information to understand when you're taking a trade. The way to come up with your R multiple, the way to come up with your risk-reward ratio, is to divide the potential reward in pips by the risk that you're going to have to place to go get that potential reward. So let's talk about an example of how to identify risk-reward ratio. Here, we can see that we were long at 1.3408 with a stop loss 6 pips below at 1.3402. 8 minus 2 is 6. There's your 6 pips worth of risk. The reward here, our take profit was set at 1.3426, was about 18 pips. So when you do your equation, again, if I go back, potential reward divided by risk, you end up with 3R, 3 to 1 here. So when we talk about, is this a good trade? Is it not a good trade? Understanding how to identify the risk-reward ratio is very, very important, because you don't want to be getting into trades where your risk-reward ratio is less than 1R. There are situations where I will get in the trade if it's, well, let's risk 5 to go get 5 or risk 20 to go get 20. Sometimes that makes sense, especially on days where you know the probabilities are still in your favor to get that 20. It could go further, whatever it is. Sometimes those setups are still worth it, and we're going to dive into that when we go into the chart markups. But understand on the initial jump that having a solid risk-reward ratio, to me, means having a R multiple of 1.5 or greater. So when you do your equation of potential reward divided by risk, you want to make sure that the number you're getting is greater than 1.5. That's going to put you in the position, even if you're only winning 60-70% of the time, to still be profitable in the long run. So now, a couple of quick definitions that I want you to understand before we move into Chapter 3 and talk about the charting tools. First, equity. Equity is the account balance plus the floating profit or loss of your open position. So that's all the money that you have, or if you're losing, that you don't have. Compare that to your balance. Your balance is your total amount of money not including your open positions. We also need to understand that liquidity, and I said this earlier, is the ability of a currency pair to be bought or sold. How easy is it to get in and out of that trade? Gaps are space left on the chart where price has jumped, whether it was from news or over the weekend, whatever it was. Gaps are where price has jumped because there could not be any orders filled in that gap because it moved too quickly. A couple more definitions here. We talk about volatility a lot. This is the amount of risk or uncertainty in the size of the change of a currency pair's price. So if it's a very volatile pair, you could see it move 80, 90, 100, 200 pips in a day. If it's not a volatile pair, you're going to see it move 15, 30, 20 pips a day, and it's not going to have the kind of gas that we're looking to trade on a daily basis and make money in the markets with. You also want to understand volume, which is just strictly the amount of buyers or sellers in that specific period of time. And lastly, understand what a margin call is. We talked about a stop loss. That'll pull you out of your trade if it's moving against you, but a margin call is the money in your account that can no longer cover your negative position. So what happens is if you are in a trade and you don't have a stop loss in, or if you're in a trade too big and it hasn't stopped you out yet, the broker has a percentage, every broker is different, it's normally around 70% of your overall margin that you can use, and if you use more of it, it will close your negative positions for you. Without a stop, with the stop, doesn't matter. The margin call is the broker literally used to call the traders and say, yo, you're out of the position. We had to close you. We couldn't hold it. Your loss was too big. So you don't want to experience any margin calls. And the way to do that is not use over leverage, not use too much leverage, and to use proper stop losses. Now, in the coming chapters, we're going to talk about the chart tools and the things that we use to actually do our analysis, but we're also going to go into the risk management and what you need to understand as far as how to set the right percentages, how to set the stop losses and the take profits correctly so that you never experience margin calls, so that you never experience what it's like to be over leveraged, and you can actually grow this business in a stable way over the long period of time. So again, that's our Forex terminology chapter. Let's now move in to the charting tools that we need.